Thank you very much, everybody, for joining us this panel. So the topic of the panel, what it's like to work with private equity investor. So we'll explore a few topics that I prepared, and hopefully we'll hear from the audience. But we'll start with introductions. As always, please make a brief introduction of your firm and yourself. We will dive deeper into how you operate during the panel. And if you've attended this conference before, please mention that as well. So we'll start with Joe. Please go ahead and introduce yourself.
Hi, I'm Joe Solano. I'm with Atlantic Street Capital. We are a lower middle market private equity fund, previously based in Stanford, but now in New York City. We invest primarily in service-based businesses, broad business services, healthcare, and multi-unit retail. This is my first Blackmore conference, and I'm excited to participate.
Welcome. Ken, go ahead. We can't hear you.
Can you hear me now?
Yes, we can.
Yep. So I'm Ken Bryant. I'm with Sidereal Capital Group. We're an independent sponsor focused on lower middle market companies with between 2 and 8 million in EBITDA. We specifically target family and founder-owned businesses and help in the process of institutional transformation to help them make the shift from individually operator-owned business to an institutional managed business.
Any industry specialization?
We specialize in manufacturing and business services.
Sounds good.
And
Thank you. Peter?
This is our first conference.
First conference. Well, welcome. Peter? I think you're muted on GoToMeeting. If you click on mute, should be on the bottom. On the left. If you hover your cursor over this, yeah, here it is.
Can you hear me now?
Yep. No, I do not hear you.
Peter, you might want to try not using your headset microphone, just use your computer headphones, see if it makes it.
Hear me now?
Yep.
Yes.
How's that?
Oh, that works. Good. Excellent.
Great.
I know, technology, right? Supposed to be.
Move on to Jeff.
Oh, we can hear you. You can go ahead.
I'll dial back in.
Okay, sounds good, Jeff. Go ahead.
Sure. My name is Jeff Gagne with Geneva, Glen Capital. We're based in Chicago. We're lower middle market, family office, private equity firm. So what that means is our capital comes from a single wealthy family instead of a syndicate of investors. It allows us to be a little bit longer term, more patient capital, and flexible in terms of industries. We're industry generalists. We invest in healthcare, business services, consumer, and niche industrial. And typically, we have operating executives that either become the CEO of the business or an active board member or somewhere in between, like a chairman role. And our sizes are typically companies with 3 to 25 million of EBITDA.
Thank you. Farah, please introduce yourself.
Hi, my name is Farah Holder, and I am with IMB Development Corporation, and we are based in Bethesda, Maryland, and we are a lower middle market independent sponsor. We typically look for deals that are in the 5 to 25 million EBITDA range. We do have some sector focuses. We tend to look for business services, service providers, particularly in like the gas and the electric utility space. And then we also like service providers who have government, either state, local, federal, as an end customer. We are also, I think, longer term, more patient capital. We do not have a focus necessarily that it has to be a founder-owned business, but to date, the companies we've invested in have all been, founder-owned or maybe the second generation. But typically, we do look for teams that are going to stay on board and help us grow.
Sounds good. And I'm a little bit familiar with the firm. I know you have certain areas of expertise that you deploy to create value for these companies. Maybe you can touch upon those.
Yeah, so basically, we have what we call our value added toolkit. And, once we bring a company into our fold, I mean, we do have a philosophy, to a certain extent, do no harm. We do like things to stay the same the day, after the transaction. But we have a set of tools that we like to offer to, the management teams and owners of our companies. One of the things that we have successfully implemented both at our company, at the management level of IMB and within our portfolio companies, is something called the Entrepreneurial Operating System. And this is, it's out there. This is basically, a way to think about how to operate your business more efficiently. It helps you to really define, your 5-year targets and goals. Then you break them down into smaller goals with a focus on making sure you have the right people in the right seats and making sure you have the right accountability to achieve those goals, with the end nugget being having like these level 10 meetings where you're basically having a set format and you're, bringing ideas to the table and solving them. And so we've done that, and, all of our companies have been receptive to doing it. So that's been pretty successful for us. Outside of that, we see our role as really being, the partner that helps you with your acquisitions. We basically rely on our partner companies, to run day to day. We do have strategic planning sessions with them, but we do see it as our goal to listen and, just to help you where we feel, usually in the sales area. And then, and like I said, our goal is really to help with the add-on acquisitions. So those are some of the things we do bring to the table for our companies.
Thank you. Peter, are you ready to introduce yourself and your firm? It's still muted, I believe. Now it's good?
Now.
No, go ahead. It works now. Yep.
So sorry about that. Peter Ryder with RFE Investment Partners. Been investing in lower middle market companies since 1980. Currently investing out of our 9th pool of capital. Always remain focused at the low end of the middle market, so companies with 3 to 12 million or so of EBITDA. 2 broad areas: manufacturing and services. Within those, we kind of look fairly broadly. We don't do kind of anything kind of restaurant, retail, pure consumer goods, pure volume-based distribution, and high technology. Our current investment vehicle gives us the flexibility to do all of the junior capital in our transactions. So we'll do both the mezzanine and the equity in each of our transactions, but we won't do them independently. So it's kind of a strip of securities as we kind of look at each deal, and then for smaller opportunities, we'll elect to do that over kind of raising any senior debt. So in the current market where kind of senior leverage is a little bit uncertain, we can kind of close smaller deals with our own capital without having to go to outside parties.
Sounds good. And Peter, you mentioned for that many years you haven't changed your focus from a lower middle market. What do you find attractive in that segment?
Well, I'd say that, a couple things. One, they tend to be, smaller companies. And, over the years, we've kind of operated in this environment. So a lot of our, kind of relationships for, kind of third parties to kind of help us, kind of create value within the companies, our network and other things have always been kind of focused at this end of the market. the challenges that companies face to get from 25 to 50 or 50 to 150 tend to be very similar. So it's a repeatable kind of value creation model for us over time. It's usually kind of professionalizing or building out the senior management team, kind of upgrading the financial system and reporting, and kind of converting from a reactive to a more proactive sales and marketing organization.
Thank you. So I'll start, Peter. We'll start with you. So the topic again is what it's like to work with private equity. Maybe you can tell us how you work with executives before transaction, during transaction, after transactions. After transaction, with executives who help you maybe identify and develop investment. Maybe you can tell us more about that.
Sure. So we, kind of engage with executives at, couple different levels. One, we're constantly looking at, new opportunities that come through our network. So we're always looking for subject matter experts to kind of help us evaluate those companies and understand, whether or not they're playing in a market that, we should be interested in, what the kind of key growth drivers for those markets might be, what, kind of the pitfalls in those markets might be. So just to kind of help us get smarter on, kind of the companies that we're looking at. Two, as we kind of get into due diligence, we'll engage, kind of, again, subject matter experts to help us, kind of with consulting projects as we kind of go through the more, detailed diligence, potentially sit on, the board at close. And then, we are looking at, situations where we'll partner with an executive to, actively seek platform investments where they might be more of an active executive within the team.
Sounds good. Thank you. Jeff, I know you have also experience, multiple experiences probably working with executives. The one I know very well is the healthcare executive. Maybe you can tell us more as an example, kind of to highlight how you work with executives before and after transaction.
Sure. It's pretty similar to Peter, actually. There's one is subject matter experts, but that's more tactical, where we have a particular opportunity and we're really looking for somebody to give us some insight. And that's more reactive. The deal comes first, and then we try to find the executive that can educate us or get us smarter on a particular industry or niche. More holistically, what we'd like to do is meet operating executives who are entrepreneurial in nature, are really looking for their next opportunity to own a business rather than just be a executive that's hired for a deal. I mean, that could be an outcome, but that's usually if we're proactive with an executive up front, we develop a thesis, we look at a particular industry, and ideally the executives worked in the industry for a long time, and that way they have a network already and they can help source the deals, the opportunities. That's nirvana for us. We're working with an executive. I'll mention the healthcare executive who was in the home healthcare business. So met an executive at the JP Morgan Healthcare Conference in 2014. And we spent 2 years looking for opportunities, and he actually uncovered one that he had contacted in the past, his prior life. So we were able to buy that outside of an auction process, which is nice. It's more the exception than the rule for us. But that's the benefit, is just working your network and finding those proprietary deals. It doesn't have to be proprietary, but it certainly makes life a lot easier. And then coming up with a value creation plan, what you're going to do with the business, and then 100-day, post-closing execution. In this home healthcare business, it was family-owned, or I'd say it was 2 individuals, but they were, it wasn't private equity owned or big part of a big corporation. So there was a lot of things that we could do to help professionalize the business. And they stayed on. They're still running it. Rick Andersman is chairman. He spends half his time on that business. He's compensated half what the CEO is compensated at, and it also gives him some bandwidth to go look for other opportunities. We would do another platform if we could, because it's a very regional kind of business. They're based in Philadelphia market. So that's an example there, Elena.
Elena,
thank
we have
you.
some questions coming in
Oh,
when
please
you're ready.
go ahead.
Okay,
Yeah,
Roberto,
ready.
please go ahead and put yourself on visual mode. Roberto?
Here am I
Okay, go ahead.
in visual mode. Am I in visual mode?
I don't see you.
don't know. Oh.
No, you just came on, Roberto. And there
We
you
can
are.
hear you,
Okay,
though.
go ahead. Yep.
My question to the panelists is about the expectations of the owner that may remain in the business for a variety of reasons, as a long-term earnout, adds value to the business, and the executive that brought the business to you and is responsible for making some of the value-added points that you just mentioned. And I quote Peter when he's talk about upgrading teams, systems, moving sales teams from reactive to proactive. What are the roles that you guys expect from both the owner and the executive during this journey?
So I'd say that, from my perspective, there's a wide range. It really comes down to, the objectives of the company that you're targeting, and the objectives of, the CEO candidate or the executive that you're talking to. So in a lot of the situations that we're getting involved with, we're looking at the CEO as being more of a holdco type situation where, we're trying to find a younger and hungrier team at the operating company level, but they might not have, they might not understand the bigger picture and the vision of what we're trying to accomplish. And, if we're putting multiple companies together to kind of create something unique in the market, they probably haven't had that acquisition expertise. They haven't had the integration expertise. So, having, kind of the adult at the table that's kind of at the holdco level, that kind of sits over the top and helps mentor that team, but also sets the vision and the integration strategy and looks at, kind of what other capabilities you want to build around it to create something unique. That tends to be the kind of the most common way that we're interacting. In certain situations, you might find a company where the owner entrepreneur is either non-active, or he's realized he's reached the end of his his bandwidth in terms of being able to operate the business effectively, and he's looking for help and a partner to come in and help him do that. In that case, there might be a more immediate transition at the operating company level.
Any other questions, Gerald? Thank you, Peter.
Thank you.
Not that I see.
Okay, Joe, we'll go to you. How do you see your firm's involvement with incoming executive or the existing executive team? How exactly do you help them beyond just providing the capital?
Thank you. That we do it through a variety of different paths, but I would say it's very dependent on the executive. When we first start pairing with an executive or management team, we try to understand very early on what they want their goal to be post acquisition. Many entrepreneurs have the sort of foresight and self-awareness to know that they're out of their depth. They're not the person to lead this business into the next 5 years, but they know they can lead it for the next couple. So maybe they want to transition to a role that's more business development in nature, or leading sales, or maybe partnerships. We really try to understand that early on, because that will inform ultimately how we will work with them. In touching on whether we will need to start immediately looking for a replacement CEO or COO or something of the nature, or if we want to start investing in this individual to take us through the next 3 to 5 years. But to take it to a step further for the whole organization as to how we work with them is Atlantic Street utilizes a team of 34 different operating advisors. Now, these are individuals that are exclusive to us. These are not. I'm sorry?
Yeah, I was going to ask you exactly that question, so you're already answering it. Go ahead. Sorry.
So these are executives that are these are ex-C-level executives that are exclusive to us. They are not as much, say, people who are on the later stages of their career looking to be a member of a board or actually take an individual executive position at the portfolio company. These are functional experts that are really meant to be looked at and used more as service providers. So, for example, if we meet with an entrepreneur who has issues with supply chain and procurement or business systems or sales and marketing or finance, we have various individuals who we will pair with that portfolio company, work with the entrepreneur to develop that 100-day plan so they are on the payroll of the portfolio company as really project managers to an extent to help steer the business through those challenges and get in filling those gaps where they exist. And this leads to a really hand in glove working relationship between our operating advisors and the executives at the company, to the point to where we don't even typically have quarterly board meetings. It's because these individuals are working together on a weekly basis. They agree and work on it for the report's key KPIs that are reviewed by us and the operating advisors every Monday morning before we talk about any new deals or anything. Each Monday, 2 to 3 hours is spent reviewing every portfolio company and every operational initiative that's going on. And furthermore, every week, and occasionally a bi-weekly basis, there are executive leadership calls where it is the key executives from the portfolio company, partner deal lead, and the operating advisors to just ensure that we are addressing any and all of their concerns. This isn't for us to micromanage them. This is so that they never feel like they have to chase us down or ask us for guidance or any sort of resource that we can provide them.
Yeah, that's very interesting. Have you had situation when the existing management team had a different perspective on growth or a different way to grow, a different perspective on risk of growth? And if you have, then how do you resolve issues like that?
Well, just like with any difference of opinion, a thoughtful and professional discussion ensues. We tend to defer to our executives in their areas of expertise. For example, we own an electronic healthcare medical records business focused on the fertility sector. The CEO of that business knows fertility a dozen times over than the collective knowledge of every person at the fund level. So for us to really, challenge his opinion on where he thinks gamete storage is going to go or embryo cycles, it doesn't make sense. So we defer to their expertise. Where we try and provide value is showing the opportunities and different pathways and the actual structure of what these new growth initiatives look like. Now, if there's a complete impasse, that is where, I guess, harder discussions happen. But luckily, we haven't been in a situation where we haven't been able to find a resolution to where, we've had to part ways with anyone. It's really, and I think that all comes from a very clear and open conversation at the start of the engagement. Because if they understand what we expect out of the business and what we hope to provide, those sort of uncomfortable conversations happen far less.
Yeah, sounds good. Thank you, Joe. Ken, to you, how do you get involved with either executive coming in or internal management teams before and after transaction?
Right. So our approach is similar to perhaps Peter's. There are two themes that we stick to. One, we greatly value continuity. Simultaneously, we want to instill a sense of urgency. So the way we'll normally do it, if a seller has owned a business for 15, 20, 30 years, we will have her roll over and elevate her to the chairperson of the board, so that there's economic skin in the game and we have the benefit of that continuity, insight, and wisdom with respect to both the operations of the company and the broader.
And sorry, is it a preferred strategy to replace the existing CEO, or is it more situation dependent?
Well, it's situation dependent, but they're usually selling because they want to be relieved of the day-to-day. I was on the phone with an owner yesterday, and 10 minutes into the call, he slipped up and confessed. He goes, "I don't ever want to deal with HR again." And so explain to them, hey, we can help you out on that, right? We can backfill and improve your talent base so that you can focus on strategic issues and not staffing issues. And so what we then do is we bring in a younger team with the energy and the urgency to tackle those issues while maintaining the continuity with the seller.
That sounds good. Do we have any questions, Gerald?
No.
If not, okay, so the next topic is about change. So we've heard throughout the three panels about growth and change and improvement. So I wanted to know how you deal with.
One come in. I just had actually two. So let's go to the questions and then come to your question. Let's go to KYO. Keo, please go on. Use your camera.
Yes, hello. I'm a first-time participant here. I'm just actually asking, when you have a 100-day plan that's an execution plan, and the plan goes sideways with the market situation, what do you typically respond to in terms of supporting of the operating team?
Jeff, would you like to take this question?
Sure. So is the question, when things don't go according to plan, what do we do, or specifically within the first 100 days?
Within the first 100 days, you have a 100-day plan. It's a goal plan, right? And the market situation changes, and the plan goes sideways.
Yeah, I mean, a 100-day plan is just it's a template. It's what we try to execute against, and it doesn't always go. Sometimes it takes longer. Certain initiatives, some are easier things to do. Often what we're doing is we're augmenting the team. I think like Ken mentioned earlier, like HR. So we're identifying where there's maybe weaknesses in an organization, and we can top grade certain positions. CFO in particular, usually new CFO comes in, particularly if it wasn't private equity owned before, because it's a whole different skill set to be a CFO of a private equity backed company. You the person may just stay on as a controller. That's, I'd say, more often than not, there's a new CFO on board, especially if it wasn't PE owned. And then the other key positions, sales, operations. But that's something we're very open with the CEO we're backing, whether it's the incumbent CEO or certainly if we're bringing in a new CEO. Everything is buy-in. We don't do anything. We're not foisting somebody upon an organization, and we want to make sure there's buy-in. But that's really to me we want to do that in the first 6 months or a year, is recruit the right people, because that's, until you have those filled, it's really hard to execute.
Okay. We have Jay Topper. Do you want to ask your question from the previous panel, or Scott Hine? Do you want to go ahead and ask your questions?
Sure, I can ask mine. My question is, how do you plan for, or what are the triggers when looking for an exit point?
Should I can jump in from our perspective. And so our typical hold period, or when we go into an investment, we put together the initial business plan, the target hold period is between 4 to 6 years. And that's driven by a couple factors. One is we've discussed collectively on this panel the need to make institutional and organizational changes. And then we generally like to follow that up with 1 or 2 add-on acquisitions. And so say it takes 18 months to upgrade the talent pool within a team, then it takes another month or another 6 to 12 months to do an acquisition, and then you need to integrate that acquisition within the base platform. That puts you to 3.5, 4 years before you go to exit to another firm. While we're executing on that plan, and this ties to the earlier question, there'll be situations where you can't control externalities. and the team and the private equity firm needs to pivot with the realities on the ground. And when that happens, I think our firm and most firms will be rational and commercial and accommodating. Sometimes you've laid a plan in place, and let's say you execute on 60, 70, 80% of the plan, but on the final 10, 15, 20%, you've tried your best, the team has tried its best, but it was unsuccessful in its attempts. And that's when we look to exit, when we've accomplished what we've set out to accomplish, or if we conclude, hey, we've all given it our best effort, but we lack the skill set to pull this off, then we look around the table and we say, why don't we put this on the market and give another group a chance at doing what we couldn't complete.
Thank you, Ken. And there was another question?
Yes. And that was from?
From Jay.
I think it was Jay. We had one from Jay Topper.
Jay, we don't have.
Scott Hine.
Yeah, Jay, we can't hear you.
So, Jay, we can't hear you. So if you're asking a question.
I've already asked mine and it was answered.
All right.
This is Scott.
Okay.
Okay,
so
Scott,
sounds
you're
good. All right.
fine.
All right. So I'll go to my question then, and that's about value creation. So we talked a lot about growth and value creation. So how do you exactly see it in conjunction with do no harm? I think Farah mentioned that. Maybe we can start with you. What do you exactly mean do no harm, and how do you see the change? Is it more incremental change or more transformational change, or somewhere in between? And how do you manage change?
Yeah, I think to date, the do no harm means, for the actual, portfolio company, we feel like it's our duty to listen to their vision and help them support that. So we're not going to enforce broad stroke, hey, we want this new management team, we want you to go after this market strategically. So we try to, in the diligence process before we buy the firm, we try to vet out, hey, what's your 3-year, your 5-year vision? And if we feel like that's a vision we can back, then we'll back you. And then, we'll work to put the nuts and bolts in place, as we go through, unfolding. The transformational piece, I guess, would be, just what we bring to the table in terms of, the work we do to add-on acquisition. So we wouldn't necessarily want to back somebody who doesn't have a vision for growth, because, we feel like that is our value add that we bring to the team. One of the things that we've done successfully too with our portfolio companies is, we obviously have our team at IMB, but we've been fairly successful in helping the CEOs and the CFOs of those companies and sort of training them to help us with the M&A. And so, to a certain extent, some of them too, we've also helped to, enhance their management team so they can be a little freer. I mean, I'm sure most of a lot of these lower middle market companies, if somebody's in there already, usually, they're caught up in some of the day-to-day and there's tasks that need to be taken off their plate. So we try to help them by building out the team so they can free up some of their time. And, to the extent that they do want to help us, I mean, of course, it's hand in hand. If they're not interested in helping not day to day, but if they're not interested in the acquisition piece, we don't force it. But so far, most of our, CFOs and CEOs, they found an interest in that side. And so they work alongside of us and help us.
Thank you, Farah. Peter, what is your approach to change? Is there anything you can add? I know it's somewhat similar to Farah's. Is there anything you're doing differently or at the higher intensity?
No, I'd say that, for us, we're trying to understand kind of where is the company at the point in time that we get involved and what do we want it to look like when we get to an exit. And a lot of that requires either changes in building out kind of the senior executive team, because it's not only to get to an exit, but it's also to give the next buyer confidence that the company can continue on its trajectory when they buy it, right? So you want to make sure you've got a complete enough team and a highly functioning team, so that there's a lot of confidence that they can continue the strategy when we get there. And then in between, it's kind of what are the key characteristics that you want the company to look like. So that might involve a couple acquisitions. We're a fairly acquisitive firm. We average about 3 per portfolio company. But sometimes it's internal growth, and it's attacking new channels and other things. So you just want to make sure that you've got the the right momentum at the point in time that you're looking at the exit. But I think from our standpoint, in terms of quote unquote do no harm, I mean, I think all of us around the table are trying to create value. We're not trying to pull companies back from where they are, but trying to open them up and be the best versions of themselves that they can be. And a lot of times that just kind of requires presenting kind of new opportunities to kind of do new things, and you try to do it in a thoughtful way. You try to make sure you have the right advisors around to make sure that they don't make missteps, but it's not going to be perfect, and then you've got to Ken's point, you've got to pivot.
So that brings me actually to another question I'd like to ask is, it seems like talent is really important in your strategies, right? Where, like Peter said, the objective is to create a lot of value, and things never go straight up. So it seems to me you really need to surround yourself and your company with the right talent. So what are the key characteristics of executive talent that you look for? Both on the experience side and on the personal side. Joe, we'll start with you.
Sure. We're actually going through this right now with a couple of our portfolio companies, and have brought the talent acquisition piece of this largely in-house. So the ideal talent person profile, I suppose, would be private equity experience and industry experience, right? Like you want someone who's run your type of business before and who's run it with a private equity fund. Like that's the unicorn. You can't always get both.
So may I interrupt you for a second? What kind of P&L do you look for? Larger than your company? Similar? Are you open to?
What kind of C&L?
Can you hear
I'm sorry.
Me? P&L.
P&L.
Yep.
We don't. It doesn't have to be someone from a larger platform or a smaller. Really, it's a more culture fit for the way we do business. Someone who is going to be proactive and comfortable, being in contact with us on a weekly basis. Someone who can demonstrate knowing how to scale a business through both inorganic and organic growth. We are probably largely more buy and build than many of our peers. So someone who knows how to work within what can start as a fractured organization and then integrate those pieces together. That's a key element that we always look for. So transaction experience is something that is key for us. But size perspective, I mean, typically if they run a big organization, they are more successful and have more experience. But there's plenty of individuals who are ready to move up to the next level who just haven't found the right opportunity yet. So that isn't a limiting factor for us at all.
Sounds good. What else on the personal side? Maybe what kind of characteristics are you looking for?
Well, I mean, I would say we have a pretty diverse culture set, and we like to see alignment in that arena, but we want them to be their own person. We like entrepreneurs who have sort of strong opinions as to either the business or an industry, and etc. Because if they're constantly looking to us or we're constantly looking to them, that isn't really a true partnership. We want people who have strong opinions, but also are open to changing those based off of new facts and information. Being stubborn is never a trait that we love to look for. So we always want someone who's going to be collaborative in nature.
Thank you. Ken, is there anything you can add to that? Any personal or professional characteristics that are important to you? And I see a question from Gary. What are the top 3 executive attributes that are most likely to drive success? So maybe you kind of can cover that as well.
This may be in politic, but we look primarily for one attribute, and it's people who have a chip on their shoulder. So we look for people who feel that they've been wronged or what have you in a different situation, and they have something to prove. And if they show up with that attitude that they're going to prove the rest of the world wrong, then we find we do pretty well working with them.
That's very interesting. That's a bit counterintuitive. Is that something you learned from your prior experience? Maybe you can give us an example where it really worked.
Yeah, I think in each of our examples, in each of our investments, it's actually played out and worked. Each of our successful investments, and again, to earlier conversations, something always goes wrong. And so you need to be working with people who won't accept reality and will fight through to make it right. And in our most recent transaction, we partnered with an executive in the industry who had moved up through the corporate ranks and then transitioned when his division was bought by a private equity firm. He moved up the ranks within that private equity-backed portfolio company, and then during restructuring, they laid him off. And he came back into the industry, and he wanted to prove his former bosses wrong. And we partnered up with him, and happily he's doing it. So we look for those situations. Other situations, we often work in intergenerational transfer between parents and their children in a business. And in those instances, the children stepping up, they want to prove that they can operate on their own right and get out from under the thumb of their parents. And we really look for and welcome those situations as well.
Yeah, I can imagine this kind of executives see you as their partner, as an enabler. So it must be a really strong relationship you can build. Peter, anything you can add? Perhaps I know you have expertise internally for selecting executives. Anything you can share with us from that experience?
I wouldn't say necessarily from that experience. I mean, we do have a talent management resource that we've brought in-house, a former partner out of Spencer Stewart, that kind of helps us think about talent both at the front end of an acquisition in terms of the subject matter expertise, board members at close, and then working with the CEO to build out his team. I'd say that kind of from a characteristic perspective, and to follow on Ted, Ken's point, somebody that's a good problem solver. There's always going to be things that are going to go either sideways or go off track, or there's going to be externalities that are going to kind of change the situation. So somebody can think on their feet and work through those in real time. But somebody that's confident, but yet has humility, so they're not afraid to ask for help and afraid to surround themselves with smart people so they can come up with the best solution. Somebody that is just gonna say it's I've got the best solution, and they're not willing to as Joe said, collaborate, probably not going to be a good fit for our organization. And then I'd say somebody that's not afraid to make a decision. Kind of that sense of urgency and knowing that where you started can't be where you wound up, but you can't take 5 years to make the first move. We've constantly got to moving forward, and not every decision is going to be perfect, but we need to be making change to get to the end point. So not being afraid to make those decisions with the right support is important to us.
Thank you, Peter. Jeff, so we have, let's say, we have an executive that meets the requirements, and then how do you align his interests with yours? How do you see the alignment of interest, and not only in terms of monetary compensation?
Right. Well, there's be two types of executives. One would be an entrepreneur. An entrepreneur owns a business and you're recapitalizing the business where he 20 or 40% or owns that much post closing. So he still has some interest there. I think probably more relevant for this group is the corporate executives, and we have robust incentive plans, typically anywhere from 10 to 15% of the equities allocated for management, and that gets, the CEO is going to have the biggest share, but we make sure it goes deep enough, but not too deep that it gets spread too thin and it's not meaningful to some of the smaller people that's less interesting or less tangible. But we do a very detailed 5-year forecast and value creation plan that shows exactly what each point of equity will be worth in 5 years if they execute the plan. Make sure they get buy-in, make sure they understand the value drivers, what you can do, and so essentially give them a 101 course in financial modeling, so they understand the power of using some debt. We typically are pretty conservative, like 50% debt, but some does help. It's relatively inexpensive capital, so it's more education. And then we ultimately are looking for them to write a personal check side by side with us, something that's meaningful, so that at the end of the day, we want them to feel like they're really buying the business and we're their financial backers, so that it feels
meaningful to them. You mean meaningful to them, right? So not necessarily to the deal.
Exactly. The absolute amount doesn't matter, but just the thought of writing a check. And then, for corporate type executives, that's not, it feels, they're not used to that, sort of writing a check into a business. So, but I think it's important. And back to the, typically we're going to target to make 3 times our money, thereabouts, at least a minimum 20% return over 5 years. But, that can be powerful. And then it gets the other management team members to buy in, literally buy in as well.
Hi,
but,
excuse me. Sorry,
sure.
The panel is off and it's done, and we're gonna have the one-on-ones meeting in 3 minutes. So please, thank you everyone, and remember to go to your personal schedules, and you can find your links and going.
Thank you so much, everyone.
Sorry, Jeffrey, to cut you off.
Bye-bye.
Sorry.
No worries. Thank you.
Bye. Bye.
Bye-bye.